I'm Glenn Campbell. I call myself a demographic philosopher. I'm looking at life and trying to predict the future through the lens of demography, or the study of human populations. And today I want to talk about assets and asset bubbles. Now, if you've heard my previous podcasts and videos, I'm predicting a big economic collapse on the horizon, that there is a recession coming, and it's going to be a doozy. It's going to be bigger than all the other recessions. But I'm not going to dwell on that in this podcast. I'm just going to talk about assets themselves and asset bubbles in general and how they work. So what are assets? Assets are anything that you can own that you hope to eventually sell or turn into some money. So an asset could be real estate. You own a house, and eventually you or your heirs will sell that house and realize either a profit or a loss. You could also own rental property and rent that property out to somebody and make some money along the way before you eventually sell that house. Assets can include stocks and bonds. They can include debts that people owe to you. Assets can include money that you have in the bank or money that you have in a money market account. It can also include cash that you have in your mattress, if that's how you choose to keep your cash. All of these things are assets, things that you own right now that presumably in the future can be turned into some kind of value. If you think of yourself as a millionaire, it means that all of your assets minus all of your debts add up to $1 million. And you determine the value of your assets by looking at the current market value. For example, if you own stocks, you can look at the last price that those stocks sold at on the stock market to determine how much your stocks are worth. So you might think that your stocks are worth $100,000 based on current valuations. So people think of these things as solid. And my contention is that they are not solid, that virtually all assets are speculative, and the value you see for them right now might not be their value tomorrow. The value of assets can instantly drop, and when that happens, wealth just vanishes from the face of the earth. For example, if the stock market all of a sudden falls 50% tomorrow, which has happened in the past, stock markets have dropped that much in just a few days, then all of that wealth that people thought they had, it instantly vanishes. It just goes away. 50% of your wealth just vanishes overnight when the stock market falls. And all assets are like that. Real estate can be the same way. You think your house is worth $500,000. Well, tomorrow it might not be. There could be a crash in housing prices, or you might simply not be able to sell your house at any price if there's no one on the market for it. So assets are a bit hard to understand. We think of them as solid, but in fact, they're very wishy-washy. And my contention is that all assets, all dollar-denominated assets, are overpriced. In other words, the stock market is overpriced, the real estate market is overpriced, everything you can own is overpriced, and that this will eventually show up in a rapid drop in asset prices. Although I'm not a wealthy man, I have some experience with assets. The fluctuation of asset prices. In 1998, I bought a house in Las Vegas for $130,000. I just got married. I married a woman with 4 kids. We needed a house to house them all in, and we bought a very nice suburban house with a swimming pool, 2,000 square feet, 4 bedrooms for $130,000. Which was a reasonable price for this area we were living in suburban Las Vegas. Now, once we bought the house, we saw that housing values shoot up over the next few years. So houses near us with virtually identical floor plans, they would sell for $200,000 and then $250,000. And the price just seemed to be going up and up in the early 2000s. So that we felt very wealthy. We still had a mortgage on this house, but we felt that we were wealthy because the value of the house seemed to be twice what we actually paid for it. And we were in the money, it would seem. Unfortunately, my marriage didn't last, and we were forced to sell the house in 2006. And although the divorce was a very tragic thing, One happy part of it is that we sold it pretty much at the peak of the market in 2006. Now, we had trashed the house. My wife was mentally ill. We had collected a lot of junk in the house. We certainly couldn't clean it up for sale, but we managed to find a home flipper, an investor who was willing to pay cash for our house as it was, so that he could fix it up and turn it around and sell it at a profit. So in 2006, we sold our house for $285,000 cash to this investor, which was more than twice what we paid for this house. So we won in that particular transaction. The home flipper, in turn, fixed up the house and sold it for $360,000. So he made a tidy profit. We made a tidy profit. I don't begrudge him for making $80,000 more than what he paid, because he did fix the place up, and without him we would not have been able to sell the house because we were in no condition to fix up the house ourselves. So the next buyer buys this house at $360,000 in 2006. And what happens next? Well, in 2008 and 2009, we had the great housing bust, where housing prices in Las Vegas and many other places crashed. And the next person who bought our house in 2009 bought it for $130,000. In other words, the same price that we had paid 10 years ago. So that one unknown person who bought the house for $360,000 took a bath. There's a tragedy there that is unknown to me, but somebody paid $360,000 for this house and had to sell it for $130,000. So somebody took a bath, and the people who lent him money to buy that house, they must have taken a bath. And this was probably part of the great subprime mortgage crisis of 2008 and 2009. For every house being sold for $360,000, there's somebody who believes that they have an asset. There is the mortgage lender who believes that the loan he made for this house is an asset, and there is the homeowner who thinks he has acquired an asset that he can turn around any time and sell for the same amount of money that he bought it for. It turns out that was a lie, that in fact that whole asset inflation, the rise in price from $130,000 to $360,000 wasn't an illusion. It was a bubble. And when prices rationalized again, they went right back to the price that we originally paid. Now, I contend that all assets are like that. The value you see for them right now is an illusion. It simply reflects the price that the last person paid for this asset. It's not necessarily the price that you will get when you come to decide to actually sell. So what is the true intrinsic value of this asset? And I don't have a formula, but my guess is that it's about $130,000. That's the base value of this asset, based on the cost of construction and maybe on the standard salaries in the area. That's something that is sustainable, the portion of the asset that is sustainable. If someone is paying $360,000 for this asset, they are paying a premium, what I call a speculative premium, of $240,000 above the actual value of this asset. And people seem to do this all the time. They pay more for this asset than any calculation says that it is worth. There's really only one way to justify it. And the one way that people justify something like that is they look at the past behavior of this asset. In other words, they look at the past history of all the sales of this house, and they see that each sale is higher than the next sale. They see that the price is going up, up, up. And what they do in their mind is they draw a straight line and think that it's always going to go up. They assume that if the price went from $130,000 to $360,000, that it will eventually go to $400,000 and $500,000. And this is the great mistake that everyone makes. If you invest in mutual funds, there is this disclaimer you have to agree to that says past performance is no guarantee of future returns. And although everyone agrees to this in principle, they still think that past performance is going to guarantee future returns, even if they waive their rights. So this person who bought the house at $360,000, they were looking at the past and they assumed that the past would become the future. And it turned out that it didn't. And when everything fell apart, when the bubble burst, went right back down to where the intrinsic value of the asset truly lies. So what are the prices for this same house today? And I can look this up online. I can see that the house later sold for $230,000. So somebody bought the house for $130 and sold it for $230 and made $100,000. And so we're back in the same game again. And according to Zillow, this house is now worth $300,000 based on sales of surrounding houses. So you kind of wonder if in Las Vegas we have the same bubble building up again. And when this happens, people are playing a game of musical chairs. They see the price going up. They don't want to miss out on a good investment opportunity. So they see the price going up. They pile onto this asset. And the fact that everyone's piling onto this asset means that the price goes up. This is a speculative boom. And it keeps going. As long as you get out of the game early, you're going to win. But of course, there's somebody still holding the deal at the time when things crash. And nobody really knows exactly when it's going to crash. They all just everyone's just piling on to this upward trend. And everyone is thinking, well, this time it's different. This time the prices are going to go up forever. I remember people telling me at the time that real estate is the one investment that always appreciates in value. It never depreciates in value. And within their lifetime, within their experience, that was true. But it doesn't mean that things can't crash eventually. This is real estate. This is real estate in Las Vegas. This is obviously a speculative market. But I claim that these same principles hold for all assets, that all assets are speculative. There may be some intrinsic value in an asset, but people are paying much more for that asset than that intrinsic value would suggest. And this is working for everybody right now. We're in November 2019. The markets haven't yet crashed, and it's working for everybody. Everybody's riding this upward trend, expecting either that it will go on forever or that they'll be smart enough to bail out before the market reaches its peak. So based on my limited experience in real estate, I want to propose a theory about assets and how they are valued. If you're trying to determine the value of your portfolio right now, you're going to look in the newspaper to see what the value of your various stocks and bonds are. And that's going to all be added up to be what you believe your net worth to be. My belief is that those numbers that you see in the newspaper are grossly distorted because they reflect only what the stupidest investor is willing to pay. The conventional wisdom about markets is that they are very smart and the markets will balance out what the naysayers and the yaysayers say and come up with a medium valuation for some product. And that's simply not true. The people who value a product, who set the market for a product, are the true believers in that product. They're not the non-believers. They're not the skeptics. For example, let's say a new Monet painting goes on the market and Sotheby's offers it for auction. Who determines the price of that painting? Well, it's not the market at large. It's only about 3 or 4 bidders who are going to bid up the price of that Monet. It's the true believers in Monet who are going to bid up the price of that painting. The same thing applies to Las Vegas real estate. The determination that my house is worth $360,000 is being made by a stupid investor, an investor who obviously believes in real estate. It's not being made by somebody who believes that real estate is overvalued in Las Vegas, because those people are just going to stay out of the market. Here's another example. I'm talking to you in November 2019. Right now there's a company called Tesla. I don't know if you've heard of it because I don't know in what year you're listening to this podcast, but in 2019 there was a lot of talk about this stock named Tesla. And Tesla is a manufacturer of electric automobiles, and their stock price is astronomical. And Tesla is a very divisive company. There are people who believe that it's hogwash, that its founder Elon Musk is a con man. They believe that Tesla is going to crash and burn. And then there are other people who believe in Tesla like it's a religion. They believe that Elon Musk is doing everything right and that the sky is the limit for this particular company. So who determines the stock price? It's not the skeptics, because the skeptics are not buying Tesla stock. The people who determine the value of Tesla stock are the suckers, the true believers who are willing to pay good money for this stock. And it's the last idiot who purchased stock from another true believer who determines the price that's printed in the newspaper every day. So every asset is like that. The current valuation, the thing that you base your assessment of your wealth on, is determined by the last fool who made the purchase of this asset. In the case of Las Vegas real estate, the market value of every house in my neighborhood is being determined by only the few people who are buying houses in that neighborhood. And the people who are doing that are the true believers in Las Vegas real estate, the people who are willing to shell out $360,000 for my $130,000 home. They're doing it because they truly believe in it. And this is distorting the market. This is distorting the prices that people see for these assets. And this can be true for anything. For Monet paintings, it can be true for stocks. The people who buy a particular stock like Tesla, they are the true believers. Whereas the skeptics who don't believe in those companies, they're staying on the sidelines and they're not buying the stock at all. So the price of the stock in low volume times is determined by whatever the true believers are willing to pay for it. Then what comes along is some kind of shock, some kind of crisis of confidence, and the people who hold the stock decide it's time to sell, and they find that there aren't any buyers out there because the market of true believers is only limited, and if too many people decide to sell, then you don't have any true believers to sell it to. You have to sell it to the sharks, and that's when the price of the asset collapses. Let me try to apply this to a completely different kind of asset. Government bonds. And this is widely regarded as the safest investment you can have. Let's say U.S. government bonds are said to be the safest investment possible, the gold standard of what a safe and sound investment is. And right now their price is kind of crazy. And the interest being offered for U.S. government bonds is really trivial. It's down about 2%. You can buy a 10-year government bond and you'll only get a yield of 2% on that bond, which is, in historical terms, it's a ridiculous price because when you're buying something for 10 years, you're taking a couple of risks. You're taking the risk, number one, that the U.S. government in 10 years' time is going to be able to pay you back for that bond, pay you back the money you invested. You're also taking a much more substantial risk that inflation is going to eat away at the value of your investment. So 2% on a 10-year bond is actually a negative yield if you think that inflation is going to go up by 3%. So these are crazy prices that people seem to be willing to pay. And it's not the skeptics who are paying this money. It is the true believers in government bonds. And it happens that there are a whole lot of true believers because we have this conventional wisdom that bonds are safe. There are a lot of suckers out there willing to buy the bonds. And it is those suckers who are determining the value of the bonds on any given day. But people are buying bonds as though inflation was impossible and as though the U.S. government was a rock-solid investment that could never fail. And both of these things are very dubious assumptions, especially over the course of 10 years. So every other asset that you can think of is subject to this effect that it's only the true believers who are buying the asset, and They're the ones who are pumping up the value. There are all sorts of other reasons why assets are overvalued. I can talk about demographics. I can talk about monetary policy by the Federal Reserve. I can talk about how low interest rates are forcing pension funds into the markets. But there's also this psychological thing that every asset is being bought by the true believers in that asset. And the people who do not believe, who are skeptical of that asset, they're staying on the sidelines and they have no effect on the price at all. And all of this comes crashing down when there's some sort of shock to the market, some sort of loss of confidence, where even the true believers decide they want to sell their asset. And they turn around and look for a market for this asset, and suddenly there's nobody willing to buy. And that's when asset prices come crashing down. That's what happened to real estate in Las Vegas. The reason that the sale price of my house fell from 360 down to 130 is that there were no buyers for houses in Las Vegas. This true believer who bought the house at 360, he finds he's under financial distress and wants to sell the house, so he turns around and there's no buyers because the market, the true believers are already saturated. He has to try to find a market among people who are not true believers, and they're simply not willing to pay $360,000. So when assets fail, where does the money go? In the case of my house in Las Vegas, somebody bought a house at $360,000, and a short time later they were forced to sell it at $130,000 at a loss of $230,000. So where did that $230,000 go? And the funny thing is, it just vanished. It just popped off the face of the earth. It simply doesn't exist anymore. You have the homeowner who invested in the house. You have somebody who owned the mortgage. And all of a sudden, the moment they sell that house, their assets go away. The mortgage holder can't collect on his mortgage, so his asset vanishes. And whatever the homeowner invested in the house, that amount vanished too. It's the closest thing there is to a magical disappearance of something. Money just vanishes. And this is what happens when the stock market crashes. Let's say the value of the stock market goes down by 50%. And we say that so many trillion was lost from the stock market. If someone put a gun to your head and stole $3 trillion from you, you would consider it a crime. But when stock markets crash and lose $3 trillion, there's no one to blame. It's simply there's no buyer willing to pay the full price that you thought this thing was worth. So money just vanishes. Wealth just vanishes. All over the planet during the 2008 crisis, wealth just vanished. It just went away. And suddenly people were a lot poorer than they were before the crisis. And when people get poorer, they change their behavior. If you thought you were a millionaire and now you're only a half millionaire, and you see your value of your home plummet, well, you're not going to behave like a millionaire anymore. You're going to be a lot more conservative with your funds, and you're going to do a lot fewer discretionary things with your money. And this has a compound effect on all of the economy. Just simply losing wealth mainly affects the rich people. But the compound effects on the economy are the rich people not spending any money anymore, not taking any more vacations, not buying any new marble countertops. And this has a ripple effect throughout the entire economy, which in turn feeds back and may reduce the value of assets even further. So an asset bubble popping is not a good thing. And in this case, in the case of the current economy, I believe everything is an asset bubble. It is called the everything bubble. And if the everything bubble pops, huge amounts of wealth are lost overnight. All those wealthy people stop behaving in a wealthy way. They become conservative. They don't spend any money anymore. And that starts a positive feedback loop, meaning it feeds upon itself and the whole economy comes crashing down. And this nearly happened in 2008. The governments and central banks saved us by various means, by lowering interest rates and injecting money into the economy. They don't have those tools anymore, so the next time big bubbles burst, it's going to have devastating effects, that the feedback loop is going to go on and on and on until everybody is very, very poor.